Today, we are doing a hedge fund grade deep dive on one of India's most anticipated IPOs, Billionbrains Garage Ventures, the company you know as Groww. With 60 million users and 13 million active traders, it's a fintech giant. But the real question is, should you invest? Incorporated in 2016, Groww has become India's second largest digital-first investment platform. It dominates in fintech, offering everything from equity and derivatives to mutual funds and digital gold. Now, it's aggressively pushing into personal lending, US stocks, and insurance. Groww's value proposition is its simple, all-in-one account. But its real success is its geography. With over 13 million active users, it dominates Tier 2 and 3 cities. A staggering 80% of its customers are the first-ever investors in their families. The future strategy is clear: get more value from their massive user base. This means cross-selling SIPs, bonds, and credit. It means launching Groww Plus for wealthy clients, and expanding their new SaaS product for financial advisors. Groww's moat is its obsession with user experience and its proprietary tech. It owns the entire stack, including an AI/ML engine for onboarding, risk, and customer support. Its popular blog and YouTube channel fuel massive organic growth. The company is founder-led, but backed by a who's who of marquee investors: Ribbit, Y Combinator, Peak 15, and Tiger Global. Crucially for IPO investors, there is no promoter selling in the fresh issue, showing the founders are locked in. The market size is staggering. India has 112 million Demat accounts, but less than 8% of adults invest in equity or mutual funds, compared to over 60% in the US. The runway for growth is enormous, with digital channels growing at over 30% per year. Of course, competition is brutal. Groww fights Zerodha, Angel One, and all the big banks. The main threats are a continued price war compressing margins, regulatory clampdowns from SEBI, and the risk of losing customers to super apps that do everything. Now, let's get to the numbers. The growth is explosive. Revenue grew 92% in FY24, and is estimated to grow another 75% in FY25, hitting over 4,300 crore rupees. This is the real story. Groww has achieved operating leverage. After years of heavy spending, its profitability is exploding. Net profit is projected to jump from 163 crores in FY23 to over 1,246 crores in FY25. The PAT margin is set to more than double. This chart shows the margin expansion story. EBITDA margins are projected to hit nearly 38% in FY25, with a very strong return on equity of 26.5%. This is a high-quality, profitable business. The funnel is the core asset. 60 million users are at the top. 13 million are active in broking. But the cross-sell is just beginning: 2.6 million SIPs, 2.8 million US stock accounts, and over 300,000 loans dispersed in the very first year. Groww's unit economics are fantastic. Their cost to acquire a new account is under 70 rupees, compared to a sector average of 220. Retention is high at 87% in the first year, and their app is sticky, with users opening it over 30 times a month. So where is the IPO money going? Almost half is going back into tech and product. 26% is for more customer acquisition, and 14% is to fuel their new, high-growth lending business. Note, none of it is for repaying debt. This is a net cash business. The anchor allocation is a massive vote of confidence. At 100 rupees per share, Groww raised nearly 3,000 crores from the biggest names in finance, the governments of Singapore and Abu Dhabi, Goldman Sachs, Wellington, and every major Indian mutual fund. Now, the most important part: valuation. At 100 rupees per share, the IPO is priced at an eye-watering 108 times estimated FY25 earnings. This is priced for perfection. Let's look at the peers. Angel One trades at 35 times earnings. Robinhood at 31. Even the private market values Zerodha at a lower 90x. This makes Groww's 108x P/E look extremely rich. A more conservative fair value, based on 50-60x earnings, would be closer to 45 to 60 rupees per share. The risks are serious. First, the valuation is so high that any small miss could cause a sharp correction. Second, a regulatory clampdown from SEBI or the RBI is a constant threat. Third, Competition is intense. And fourth, their new ventures, like lending, are untested at scale. Here is the final SWOT analysis. The strengths are clear: brand, tech, and a huge user base. The weaknesses are the valuation and churn risk. The opportunities are in cross-selling. And the threats are regulation and competition. Governance is solid. The company is founder-led with strong institutional backing. The operational KPIs are impressive: a 4.3-star app rating, 2.8 million US stock accounts enabled, and over 1,500 crores in loans already dispersed. The market sentiment is red hot. The IPO was multiple times oversubscribed, backed by the strongest anchor list in history. The gray market premium, or GMP, is trading 33 to 38% above the issue price, meaning the market is expecting a strong listing pop. So here is the final decision. The bull case is that Groww doubles its users and ARPOO. The bear case is a tech war or regulatory crackdown. For investors, this is high risk. It's either a tactical buy for the listing pop or a long-term core holding for an aggressive, high-growth portfolio. Expect extreme volatility.